Hi, I'm Mike Cintolo, Chief Analyst of Cabot Growth Investor and Cabot Top 10 Trader, and I'm here with your Cabot Weekly Review, and I am recording this, as usual, late Friday morning, this time October 14th. So net, as I record this, it's actually been a relatively flat week in the indexes, but of course that sort of covers up a lot of the volatility that's gone on. Coming into Thursday, we had seen, I think it was 6 straight down days in the market. Indexes had lost a few percent. A lot of stocks were getting hit. We had another round of super bearish, sentiment surveys and money flows and all that sort of thing. And we had been seeing, which I'll show you in a second, some short-term positive divergences in the broad market. Then we kind of had that bad inflation report. The market tanked to new bear market lows early Thursday and reversed on big volume, and a lot of stocks did the same. So then the question is kind of like, what, if anything, does it mean? Well, what I would say is the whole package of evidence, including the fact that, as I've said, everything is so obvious right now, the Fed and they're tightening and all this stuff. The whole package together, yes, we have seen this collection of evidence at some major lows, at 2009, 2020, stuff like that. So yeah, you got to keep your eyes open. But we've also seen this sort of stuff during declines, and the market just keeps on declining after this. So it's not any sort of real, long ago I gave up the sort of 1 and 2 day reading into too much into 1 or 2 days sort of thing. So it's a nice line in the sand. I think that's probably the way to think about it. And now you don't have to guess about anything. You just have to let the market tell you. If this is, something for real, if this is sort of the, at least a near-term bottom and we head into earnings season, we'll start to see some positive gaps. We'll see some stocks that are holding up really push ahead on big volume, so on and so forth. And obviously we'll see some buy signals from our trend following indicators. But at this point, it's just one day. It's good to see. Up is better than down. But that's all there is to it. In Cabot Growth Investors model portfolio, we haven't changed anything. We're still about 80% in cash, heavily defensive. Sometimes 80% doesn't seem like enough, okay? But whatever it means to you, I just think it's best to be very cautious, defensive, however you want to put it, and just keep waiting patiently. That said, it's also important to remain flexible, given that everyone is leaning bearish. Everyone knows all the bad news, like I've been saying. So just stay flexible, keep your eyes open. Maybe yesterday was the start of something, maybe not, but you just want to be ready for when it comes, okay? Let's hop into the charts. I'm going to start this week with stockcharts.com, which is you can use it for free. You can sign up for it. We use it all day long just when you're looking for charts, as opposed to screening or fundamental numbers. Nothing too in-depth here. I just wanted to show you a couple things. And again, this is short term, it's secondary, but we do like to look at the number of stocks hitting new lows. It's our favorite measure of sort of the broad market's health or not health. Okay, so this is the number of stocks hitting new lows on the New York Stock Exchange. And back here on September 23rd, this is just during this latest down leg of the past 2 months, right? Since late August, I guess month and a half. It peaked on September 23rd. You can see it was up around here, around 1100. Yesterday was 934, but the peak was actually 3 weeks ago. And you can just see, just as we flip over, these are both the same length. These are just a couple months in length. This is the New York Composite Index, and this was the September 23rd right here. Okay, you can see where the shaded area is right there. So you can see since then the index has gone lower, especially yesterday morning it went lower, but fewer stocks are participating. Again, it's one of those things like, what does it mean? Nothing yet, but again, it's something that has been seen in past bottom areas, so we'll see how it goes. We'll just do one more quick. This is the NASDAQ, and I'll look at the the NASDAQ new lows. Same thing. So the peak here was 1,200. These are NASDAQ stocks hitting new 52-week lows. By the way, 1,200, it's a lot. I mean, I'm not an oversold guy, but day after day after day of 500, 1,000 new lows, it's certainly a lot of selling pressure is being exhausted or at least being used. But 1,200, September 23rd, same thing. That was the peak, and here was the 23rd back here. Okay, so you can see this day right here where it's shaded. That was actually the peak number of new lows on the NASDAQ. And obviously we've gone lower since. Okay, so it's a small positive divergence. Okay, well, let me just move back to MarketSmith here if I can see if I can do this. But it's just something that we like to keep an eye on because it is something that's usually seen near market lows. So the longer it goes on, the better, especially if the market hasn't hit a low and we just kind of cascade from here, but the number of new lows remains sort of south of that peak from 3 weeks ago. It would just kind of tell you that there's more resistance to it. We saw this in 2020. I'm not drawing a direct parallel there, but the peak in new lows was actually, you remember the whole decline was only 4 or 5 weeks. It was kind of a crash with the pandemic. the peak of new lows was actually a couple of weeks before, I think, the actual low in the indexes, which was kind of an early clue. So we'll see if that's the case now. It's just something to monitor. Back here in MarketSmith, this is a product from Investors Business Daily. You can learn more at marketsmith.com. You're going to see where we're at. I mean, the indexes are putting up a fight here near the May, June lows. I will say that this week, it's just in these downtrends, it's like you get this stuff to hold up, and then they come around for it. We saw that at least earlier this week with a lot of growth names that had been holding up. They kind of came under the knife. Some of the other areas weren't quite as bad. But either way, you can see, we'll see if they fight, if this is a line in the sand at 10,000 or whatever the low was here. There was good support volume, but we need to see more than, 1 day up or even 2 or 3 or 4 days up. We're going to need to see the market hit its highest level in 5 weeks. And 5 weeks ago, I don't know, it's somewhere back here. So, unless the market's doing this next week, we're not going to be in an intermediate term uptrend. So let's just take it day by day. Most of the indexes are in the same spot. I would say that I saw an interesting chart today. I'm not sure if I can recreate it here on MarketSmith. This is the S&P 500. This was the New York Composite we were just looking at before. It was actually a little bit weaker, but you can see, the peak and new lows was here, but we've kind of hacked lower since then. We'll see how it goes. We just need to see some up. The longer these things can hold up in this range and at least stop going down, the better. But of course, that's like the first step of, 5 or 6 or 7 steps we need to see. What is interesting is, actually, I'll just use let's see if we can get this. Yeah, so this is the Russell 2000. This is IWM. And on the chart, pretty much the same thing. But number one, it is holding that June low a little bit better than the other indexes. And on the weekly chart, let's see. It's hard to see on this, but so this blue line is the relative performance to the S&P 500. It's not dynamic enough. Let me look at the daily chart again. Sorry to bounce back and forth, but you can kind of see it's not perfect, but you can kind of see right here was the low of the relative performance line. So small caps have been gradually outperforming, holding up better, I guess I would say, than the large cap stocks. Again, that is sort of something you see near lows, but, this is all just we're just kind of looking for breadcrumbs here and see what happens. Okay, it doesn't mean we can't come in and just melt down here next week or later today. Either way, it's holding up a little bit better, which is just something to note. Mid-cap stocks, same sort of thing. You can see they're holding their June low here. And this is a little bit clearer. You can kind of see here's the relative performance line. Let me clean this up. Here's the low of the relative performance line, higher low here in June, higher low. Now it's hitting, I don't even know, this is hitting multi-month, maybe going back a year or something highs relative to the S&P 500. So, just something to be aware of. Maybe small caps, mid caps, maybe they've discounted it more. Of course, they didn't go up as much. They topped out earlier, I think, generally speaking, than some of the popular large cap stocks. So when digging down into indexes here, chips is still a thing that I'm looking at closely for growth stocks. They're really one of the weaker major index or major sectors, I guess I would say, that I follow. You can just see, whereas, like small caps in general, we're kind of holding up here. You can just see chip stocks are way down here relative to their June low. Again, nice reversal yesterday, and who knows, maybe if we have another big day today or we go down this morning and find support again, again, maybe you have something short term to work with, but you'd really like to see chip stocks at least find their footing. It's going to be hard if the NVIDIAs of the world and all these things are just tanking for growth stocks to really get out of their own way, okay? On the flip side, I would say financials, which is not my thing, but financials look a lot more like, say, small caps than they do some of the other indexes. They are holding up a little bit better. Of course, some of these things are tied to higher interest rates, but it is what it is. Usually if financials hold up, it's a small positive, but just something to keep your eye on. Biotechs, this is the XBI. Again, this is kind of short term, but I mean, number one, it's still way above its prior low. So biotechs are showing relative strength. And big picture, just if you don't remember or new to the video, the XBI hasn't gone anywhere. This was the peak back in 2015. They were a huge leading group from like 2011, 12, 13, all the way into like 2015, 2014, 2015. And they didn't do anything net after this correction for, 8 years now? 7 years, whatever it is. They've been out of favor for a while, certainly not leading. But you can see it looks like they've bottomed here. They're much higher lows. And short term, just to clean up this chart, you can see while the indexes were kind of knifing to new lows. We got a little bit of a higher high here. So let's see. Doesn't mean anything yet, no. But this is one of these things where a couple of good days in the sector, you're saying, ooh, this actually looks kind of like maybe a little bit of a, kind of a first stage base, so to speak. Okay. And last but not least, out in the sector front, I just would mention materials. It doesn't look great here when you just look at it. You're like, but I'm just noticing that it, excuse me, kind of held this low and maybe could be in this sort of bottoming area. Obviously it got hit very hard here. This isn't so much energy. This is mining materials, copper, that sort of stuff. So it's a little bit out. It's commodities, but it's sort of a piece of the commodity world. But it did kind of look like it's trying to round out a bottom here. Obviously, it's going to need to head higher from here, for that to be confirmed. But so far, not so bad, okay? In terms of individual stocks, I'm just going to run through. Some of these I've mentioned before. A lot of them I haven't. They're just charts. I just went through. I like to cast a wide net in these environments, just see what's holding up, Doesn't mean you're going to go buy every single one. AXNX I've mentioned. It's a little bit thinner. AXNX. This is a legitimate... I'm not saying it's ready to break out tomorrow or Monday, but it's a legitimate big base. You know what I mean? It had a prior uptrend, big corrections, come all the way back. Now it's kind of 5 weeks into this. I've mentioned before that when you get these deep corrections, especially in bear markets, these things will often form sort of a multi-week or even multi-month consolidation that's tighter and much more proper before really getting going. So maybe that's happening here. We'll see. It certainly is getting tossed around, but you can just see the relative performance line is at new highs here and a nice trend. So that's one I'm sort of keeping an eye on. I mentioned biotechs. There's more speculative ones, and I've mentioned some of the ones that have the sales and earnings. This one's more speculative. It's Iveric. I think I mentioned this last week. ISEE. ISEE is the symbol. Obviously, it works with eyes. But it had big news back here. That's why the stock basically doubled. Sharp pullback, but impressively to me, as soon as the pressure came off the market, the stock has spiked. And you can see even this week, it really hasn't had any give back. Would I be chasing these things higher? Me personally, no. But just to keep an eye on it, the longer these things hold up, this thing has every reason to just croak, especially if the market goes further south. So the longer it can do kind of the unexpected, the bigger the message is probably sending you. Biogen is the other one, and I think I mentioned this as well. I just noticed this, obviously it's been a nothing burger for years. It's just been gross. And it has had a lot of these spikes. You can see on the weekly chart, a lot of these spikes on news, and there was an Alzheimer drug and that failed and yada, yada. This chart goes back 2 or 3 years. So it's just been a fire pit in terms of throwing your money into it. But then we get another one of these gaps, and it's kind of like, okay, what happens? You'll just notice that, this one tightened up for a couple weeks and then fell. This one kind of tightened up for a little bit. I don't know. It's usually failed pretty quick. This one collapsed the next week. So the longer it can kind of hold up, especially in a crappy market, pardon my language, but especially in a bad market, I just noticed this was kind of a normal pullback, nothing too dangerous here. And then yesterday, big volume support, and the stock really leapt. You know what I mean? It wasn't like it went up a few points. So we'll see. I mean, maybe it comes and revisits, but I'm just sort of looking at this as maybe like, hey, our institutions accumulating the stock thinking, okay, we're buying this for the next 2 years because some drug's going to get approved and all this sort of thing, okay? Even though the current numbers aren't anything to get excited about, that big volume clue in a big liquid stock is something I always keep an eye on, okay? CROX, this one's kind of interesting. CROX had a huge run. You can see the post-pandemic run here, and then it got just destroyed. Earnings have been okay. I'm not saying it's your greatest growth story, going forward, but it's cheap if that's what you care about, 8 times earnings. And again, you're kind of, you're not going to have many stocks like AXNX, which is up here and could break out of a legitimate base. What you have is a lot of stocks that went through the ringer, bottomed, rallied pretty nicely, and now they're kind of fighting in here with the 200-day line, but net, I'm not going to count this out, but call it 2.5 months, the stock has been consolidating in here, and it's not, resistance has been tough to get through. So until the market gets going, it doesn't count for anything. But the longer it can kind of hold up, maybe a couple of good days, it could get going, okay? Interactive brokers, I find this interesting. It's just a legitimate bull market stock. And again, it's sort of in this long kind of consolidation base building phase. But it's acting pretty well in here and actually found some good volume buying last week. It's higher this week. And so we'll see how it goes. It's just IBKR. There is overhead resistance, but you can see it's toying here with its highest level since February. So that's pretty good, okay? Duolingo, I mention this every week. I don't know. So maybe it falls apart. You can see now this is what happens. They hold up, and then maybe they fall apart. But I still look at this again where it's much higher than it was at the lows in the 60, 65 area. And the weekly and the daily chart are kind of sloppy. But I still look at this as kind of this sort of flat area. Now, obviously, if it cracks through the bottom of it, forget it. I never mentioned it or whatever. But, just keep an eye on it. See if it can hold up here. The longer it can hold up, the better. Or maybe you get a shakeout and a big recovery sort of thing if the market can get out of its own way. But still an interesting name, still an interesting story to me. XMTR, I mentioned this last week. This one it has pulled back this week. But again, you kind of have this sort of decline, a little bit of a bottom area, nice rally, and now just a test of the 10-week line. Maybe that's not enough. Maybe some of these things that have had these runs, maybe it just needs to really correct like the rest of them and build some structure. But obviously the resilience is noteworthy. Big story there too, XMTR. 5 below, you can see just all different sectors and stuff. So 5 below, again, this one's not as dramatic where I'd like to see more of a rally to show that people were buying it, like an earnings gap or something. But nevertheless, it did pull back sharply. It hasn't done anything. If you look at the monthly chart, this is back 2018. Net, the stock hasn't done much in 4 years. So it's not like it's super hot. It's obviously come after this bear market. And it's still got this, it's a little sloppy this week like everything, but it's still got this little structure in here battling with the 200-day line. Again, it's one of those names where like if the market perked up and the stock had a good earnings reaction or whatever, you're kind of like, oh, maybe we got a little something to work with, but keeping a distant eye on it. Energy still looks okay. CHRD remains one that, it's, again, resistance on pretty much anything has been rejecting stock. So if you want to nibble, not saying you have to, but if you do, dips, shakeouts, that sort of thing, and just see how it goes. But to this point, this is one of the more resilient oil names for sure, really energy names, still not far from its old high here. That's one. Just mentioning Pioneer Natural Resources, PXD. This is another one. It's sloppier today, but it had this sort of, I don't know, I counted it earlier, but it was 5 or 6 days out of 8. It was like 8 days up in a row, and 6 of them were on above average volume, which is, after obviously it's kind of been washed, around here with the market here lately. So that kind of tells me that maybe the institutions are saying, all right, enough is enough. Dividends, share buybacks, all that sort of thing is going on there too. So PXD's one to watch. A few more names. Chart Industries. I've mentioned this on and off. Honestly, the stock looks fine. On the weekly chart, you kind of have this correction. Then you have sort of another base. Now you have this other base. It looks like, and it's got big earnings estimates. It's a little bit of a lumpy story in terms of it's not a perfect story, so to speak, in terms of big contracts come in and all that sort of thing. But you can certainly see that the stock, look at the relative performance line, pretty much trending higher. It certainly seems like the stock wants to get going. Of course, it's probably not until the market gets going, but just a name I'm still keeping kind of a distant eye on. Progeny, PGNY, this is all about babies. It's a health insurer, actually, but kind of a niche player. This is kind of what I like to see more. Obviously a big decline, but at least it had this earnings gap. You see a couple of weeks of really big buying volume. Granted, this is a little bit of a thinner name, so it's not like we're dealing with Biogen here, but still pretty big buying volume. And then really nothing here. You see it's been 2 months of bad market and yada, yada. And there's been very low volume, number one, and kind of just a grudging consolidation decline sort of thing. So again, this is one of those where a couple of good days you're kind of interested. Health Equity, HQY. I mentioned this a few weeks ago. It had this 4 weeks in a row of accelerating buying volume. I think this is a little bit of a, believe it or not, even though it's sort of health savings accounts, the symbol is HQY. It's sort of a play on higher interest rates, but overall, it kind of fell apart back here, built a nice base, and looks like, again, it kind of wants to get going if the market does. I'll mention CalMaine just for those people who love to buy egg companies, but CALM, this has had a history, I joke, but maybe it shows on the monthly chart. CalMaine it's actually been, you can see it's done very well over the years. It does have a history of when it can move. This is a monthly chart. When it can move, it can really move. Of course, it's not revolutionary or changing the world, but when there's some flu going on or whatever, and egg prices go up, the stock can move. And you can see the stock, it's choppy, it moves around, but it's sitting near all-time highs, CALM. And last but not least, I probably should have put this earlier, this is Regeneron, it's biotech. Kind of like Biogen, it's profitable. Some of the earnings went nuts because they had some COVID stuff going on. Now that's obviously fading, thankfully. But they do have, obviously this was a big reaction here to some news in early September, and it's totally acted normally, like almost like you wouldn't know the market's imploding here in the last few weeks. This just looks like it's a normal market environment, and the stock's acting pretty well. So it is all over the place. You have to, if you want to nibble, again, I would favor dips. 750 is some sort of resistance, so my guess is it backs off. But a lot of biotechs are still acting pretty normally, if not going up, okay? So back to the market. Really, I mean, I could have come on here and just said, Thursday's interesting, we'll see what happens, but nothing's really changed. See you next week. And that's kind of the message is, hopefully this is a line in the sand. I mean, hope is a 4-letter word in the market, but hopefully this is a line in the sand that the market can at least defend or work off of, so to speak, in the next few days. And then we'll see about earnings season and just kind of take it step by step. But at this point, we've seen, I mean, how many times have we seen a couple of good days just, lead to some sort of implosion? I would say the one thing that was a little different was it came on bad news. So maybe the market is finally looking ahead to February, March, April and saying, okay, we know the Fed's going to raise a couple more times, but then they might stop, something like that. So we'll just keep an eye on it. I think we're going to know pretty soon here in the next few days whether this is a short-term low, because we'll get some follow-on buying. We'll get some stocks to gap on earnings. Right now, though, I think, cash should probably be your largest position, or at least you should be cautious and defensive, whatever that means to you. But also, like I said at the outset, remain flexible here. The market has a way, like I said, of looking ahead. So you want to be flexible in case a turn does come, in case some of these stocks I just mentioned do pop out of there on earnings and they have some buyable opportunities, whether it's a trading rally or the start of a new bull market. Okay, that's all the time I have for today. Thanks for listening. And as always, come by again next week for another Cabot Weekly Review.